Good evening, everyone, and a warm welcome to all the viewers of this webcast of EAC on recent EAC opinions under India's framework. I'm joined by Vice Chairman, Expert Advisory Committee, CA Piyush Chhajarji, and our speakers for today's webcast, CA Vivek Nevatia ji, CA Navneet Mehta ji, and CA Guru Prasad ji. And our Chairman, Expert Advisory Committee, CA Dr. Devashish Mitra ji, also has joined us. I welcome you all. And I would request our Chairman, Expert Advisory Committee, to give opening remarks. Thank you, sir.
Thank you very much, Parul Gupta ji. See, who is the Secretary of the Expert Advisory Committee. I'm sure that the Vice Chairman, Piyush Chhajarji, will also join you sometime. To those of us who are listening to me, I am now sitting in Abu Dhabi. Now, you may ask me, what am I doing in Abu Dhabi? In Abu Dhabi, we are having the World Investment Forum. Organized by the United Nations. And now, what has the Institute of Chartered Accountants of India got to do with that, you may ask me. Now, you see, the Institute of Chartered Accountants of India, through its global branding group, has set up a pavilion here. You can see the pavilion. I don't know whether you can see it from far. I can hear, you see, the pavilion that we have put up here, right? So this is the pavilion that we have put up here. Now, today, you see, so this is the pavilion that you have put up here. Today, the Secretary of UNCTAD visited our pavilion and was also very much, you see, she was speaking very highly of us. Let me tell you, in the pavilion, there have been a lot of display of books. And one of the books that is there in the pavilion is the Compendium of Opinions. Parul Gupta will feel good about it. Compendium of the latest edition of the Compendium of Opinions we have put up. And there are about more than 5,000 delegates from all over the country in this World Investment Forum. And so many have been looking at this Compendium of Opinions and inquiring about the kind of opinions that you issue and what does the Expert Advisory Committee do. Now, set up in 1975, Expert Advisory Committee has issued, I believe, more than 1,600 opinions till now, Parulji?
Yes, sir.
Yeah. And the Compendium of Opinions. We have got 42 volumes of Compendium of Opinions. Have a look at them. Fantastic. You see, today itself, we had a meeting of the Expert Advisory Committee, which I was chairing from Abu Dhabi. We have finalized 3 opinions today, and opinions on the most complex of subjects. And today, most of the opinions, they relate to the India's framework. It does not relate to AS framework anymore. So this committee has been doing a great service as long as the profession is concerned, providing its opinions on various complex issues. And then we have, this search engine. Go for the search engine and search the opinions that you have given. I said more than 1,600. And you see, enjoy the opinions. So many have thanked us, saying that, look, the opinion that you have given helped us in taking a call on how to present our financial statements. So, you see, take full advantage of the Compendium of Opinions of the Expert Advisory Committee. I believe today, 6 opinions will be discussed. Some of the best in the country, the best brains in the country on accounting issues will be discussing this. I say enjoy this, enjoy the discussions, enjoy the complexities of the issues involved. And also note the way we have resolved the complexities and at the end come out with an opinion. And mind you, all these opinions that you have issued are never challenged. They have been accepted by all the stakeholders. Many of the opinions, many of the requests that have come to us for opinions have come from CAG, SEBI. So many of the regulators, they come to us with requests for opinions. And you see, we take so much of time to look into the intricacies and then come out with our views. So, ladies and gentlemen, this is Devashish Mitra, immediate past president, chairman of Expert Advisory Committee from Abu Dhabi, having great pleasure speaking to you and requesting all of you to enjoy this presentation. Thank you very much. Over to you, Parul Gupta.
Thank you, sir. Now I would formally introduce our speakers for today's webcast. CA Vivek Nevatia ji. He has a professional experience of more than 20 years and is currently a corporate member of EAC. He has been associated with EAC in past in several capacities. He is also a member of India's IFRS advisory group of ASB at present, and has also served as a special VP of ASB. He has also been authorized by IBBI as a registered valuer. Then our second speaker, C. Navneet Mehta ji. He is also an expert in accounting and auditing matters. He has an experience of almost 15 years in IFRSs, Ind ASs, and Indian GAAP. He is also currently a special invitee of EAC and has also been the special invitee of ASB in past. He has also served two large accounting firms in the past. Then last but not the least, CA Guru Prasad ji. He is a chartered accountant having 25 years of professional experience. He is co-opted member of EAC and has experience of working in different business segments as an auditor and also as consultant to the management, and has experience on executive boards of NPOs as well. Welcome to all. Thank you, sir. Over to you, sir. Guru Prasad ji. He is our moderator for today's webcast. Over to sir.
Thank you, Parul Gupta ji. Thank you to Dr. Debashish Mitra sir for having given us an update on what is happening in Abu Dhabi, and then that the opinions given by the institute are being looked into, and then they are being used there also. There are about 6 opinions we are about to discuss today. Basing on my experience earlier, all the 6 opinions, we couldn't run them because each of the opinion require necessary amount of time. So let us see if we can complete all 6 today. Without wasting much of time, I would go ahead with the presentation on the EAC opinions that we are going to discuss today. Before we start, just a word of caution. In case if there is any divergence between the presentation that is being presented here and then the relevant publication of the institute publication should be considered as an authoritative version, and this presentation may not be relied upon in case there are any divergences. So let me go ahead with the first issue on hand. It is presentation of accrued interest in the statement of cash flows. Facts of the case are like this. A corporation prepares its statement of cash flows as per indirect method. The corporation has invested its savings, liquid assets in fixed deposit and gained interest of rupees 2405.54 lakhs during the financial year 2020-21 on accrual basis. An amount of rupees 2244.75 lakhs has been credited in its bank account against such gain, and rupees 160.79 lakhs net accrued but not received during the year. For the presentation of the above mentioned interest amount, the corporation deducted rupees 2405.54 lakhs from the profit to reach the actual cash flows from operating activities, and the same amount is also shown in the cash flows from investing activities as per the past practices of the corporation. As per the auditor, as per paragraph 31 of Ind AS 7 statement of cash flows, interest and dividends received should be classified as cash flows from investing activities. The interest received by the corporation during the year 2020-21 was rupees 2244.75 lakhs. However, the same has been incorrectly depicted as rupees 2405.54 lakhs in the cash flows from investing activities due to non-adjustment of accrued interest. Further, the cash flow due to increase in accrued interest of rupees 160.79 lakhs has incorrectly been included in cash flows from operating activities. This resulted in understatement of cash flows from operating activities and overstatement of cash flows from investing activities by rupees 160.79 lakhs. The query that we have on hand is whether the company should continue or discontinue presentation of interest received on accrual basis in the statement of cash flows. To discuss this particular opinion, I request CA Navneet Mehta sir to deliberate upon the facts and then about the query that we have on the hand. Thank you, sir.
Thanks, Guru Prasad ji, and would like to thank ICI and EAC for giving such a nice platform to interact with our CA friends and disseminate knowledge. If I look at this query and if I just have to summarize the facts, basically the company prepares its cash flow as per a indirect method, and the company has surplus funds and it has invested into the fixed deposits and gaining interest on it. Now, whenever we prepare the cash flow, I think the two things are very important. One thing is the basic difference between the cash flow and P&L and balance sheet is the basis of preparation, that P&L and balance sheet is based on the accrual basis, whereas cash flow is on the cash basis. Very obvious thing. And the other thing is whatever the non-cash adjustment, whatever we are adjusting for the non-cash into the cash flow, that it has two impacts, and the removal and the elimination of the non-cash impact from the correct activity. I mean, from the investing, financing, or operating activity, that has to be correct. I think these two are the basic fundamental principles. And whenever we are preparing the cash flow, these two things should be kept in mind. And I think in this query, the basic point is missed somewhere, and that's where it was incorrectly presented in the financials of the querist. So the company has deducted amount credited in the P&L under non-cash and other adjustment caption and added the same amount into the investing activity. So while C&AG, while conducting the supplementary audit, they raised the issue that this resulted in the understatement of the operating cash flow and overstatement of investing activities. So basically, in this case, that the item of income or expense, which is recognized on accrual basis of accounting in a statement of P&L and balance sheet, will not become part of your cash flow unless it represents changes in cash and cash equivalent during the reporting period. So basically, under indirect method of preparation of a statement of cash flow, profit and loss is adjusted for the effect of item for which the cash effects are investing. And then while presenting the cash flow from investing activities, non-cash transactions should be excluded. So in the given fact pattern, out of the total interest income of 2405.54 lakhs, the net accrued interest was about 160.779 lakhs, which was the non-cash transaction. And that is not received in the form of cash and cash equivalent. So therefore, this portion of accrued interest, which is non-cash, it should be excluded from the investing activity while presenting the investing activity. And at the same time, the impact has to be nullified in the working capital changes, which is forming part of the operating cash flows. So basically, in this case, the querist has not nullified that impact into the operating cash flow. So because of that, the operating cash flow is understated and investing cash flow was overstated. So the other thing is, so these are the very common, I would say very common issues while preparing the cash flow. This is one of the example. The other example could be that the capex creditors. This is not forming part of this query, but just would like to highlight that what could be the common pitfalls while preparing the cash flow, like capex creditors. So generally the capex creditors should have been adjusted in your investing activities, but in practice, sometimes preparers missed it and clubbed it into the operating activities. Similarly, the loan processing fee. So under Ind AS, your borrowings are carried at amortized cost through EIR, effective interest rate. And loan processing fee, after the first year of the borrowings, it is the non-cash item and which should have been adjusted in your financing activities. Similarly, the provision for ECL, liabilities return back, all these are non-cash adjustment which should have been properly adjusted in the respective activities. The other common pitfall in the cash flow which I have seen is basically the non-cash transactions. Whatever the investing and financing non-cash transaction, that has to be, there is a specific requirement under Ind AS 7 to disclose it separately from your cash flow. All the non-cash transaction has to be disclosed separately to give the true and fair picture and the correct information to the users of the financial statements. Obviously, while presenting the cash flow, especially for this interest received, Ind AS 7 says that interest received, interest paid, and dividend received. For the financial institution, this should be forming part of the operating activities, whereas for other entities as in other than financial institutions, your interest paid should be part of the financing activity, whereas interest received and dividend received should be part of the investing activities. And here there is a carve out from the IFRS. Under IFRS, the other entities have option to disclose interest paid, interest received, and dividend received as part of operating activities as well. So these are few points which I would like to highlight on this query. Thank you. Vivek, would you like to add something on this?
I think you have beautifully brought out the issues here. I think it is a very common error which is observed in the financial statements, that what we do is on an accrual basis concept, we add back or nullify the effect of interest paid and interest received and put in the same figure in the investing activities and financing activities respectively, which would not be the correct picture of cash flow statement representation. Even, when you look at Ind AS 1, I think it very clearly stipulates that an entity has to prepare its financial statements except for cash flow statement using the accrual basis of accounting. So it is except the cash flow statement which has to be prepared under cash basis of accounting, and only the movement in cash and cash equivalents need to be represented very fairly in the cash flow statement. Even the interest accrued but not paid, for example, there could be scenarios where interest accrued is converted into funded interest term loan, and there could be various scenarios which could arise in the financial statements of a company. And these are non-cash adjustments, and therefore these have to be appropriately reflected in the respective category, whether it be investing, whether it be financing. So if we are missing out on that, I think we are missing out on the basic concept of preparing the cash flow into three categories, which is operating, investing, and financing. So the respective buckets in each of the categories should go into the respective buckets for a true and fair representation of the cash flow statement. I think this is a very important point. I think this is a very common error that we observe in the financial statements while preparing cash flow statement. And honestly speaking, its cash flow statement is probably the least looked after area. And we finalize at the end as we as auditors look at the fag end of the audit. So this is something which should be looked at. Anything from you, Mr. Guru Prasad? I think.
Both of you have wonderfully put out what is said in the opinion. Even if you see the opinion is also, it only runs into 4 pages. Basically, the concept behind this particular query is it is being followed like that for several years, and several PSUs doing in the similar lines. That is what the queryist also said in the query that he has raised. So basically, as Navneet sir has rightly put out, even in the opinion, they have gone to the basics. Basically, the question is on basics here. So they have gone into basics. What is the purpose of cash flow? And then as Vivek ji has rightly said that in preparation of financial statement, except for cash flows, it has to be on accrual basis of accounting. All this has been very well brought out in the opinion. And you have touched upon all the points that are there in the opinion. And since we do not have any queries from the audience as such on this particular opinion, if there is nothing else to be added by both of you, we would move to the next opinion, sir.
Yeah, Guru Prasad, just one thing would like to highlight to all our audience that in the cash flow, there was the recent amendment on this non-cash transaction to be disclosed under Ind AS 7. So all the non-cash investing and financing activity, for example, whenever there is a liability to equity, conversion of the debentures into the equity, ROU asset and the lease liability, which is again the recent Ind AS 116. So all these things should be clearly disclosed in the financial, and that is one of the disclosure requirement by Ind AS 7.
Thank you, sir. Thank you for your addition to the topic. Thank you. So we will move on to the next EAC opinion that we have picked up for today's discussion. Let me share the screen. So the next issue that we are going to discuss is on accounting treatment of delayed payment charges. The facts of the case: a company is engaged in the business of distribution of power to the consumers of the state. The company collects delayed payment charges as per regulations of State Electricity Regulatory Commission (SERC) on overdue delays. The company has classified delayed payment charges under the subhead Other Operating Revenue under Revenue from Operations in the Statement of Profit and Loss, and under Cash Flows from Operating Activities in the Statement of Cash Flows. As per the auditor, as the amount of consideration of late payment surcharge varies due to difference in timing of payments, and it is to compensate the entity for time value of money. The nature of late payment surcharge is that of finance income, and the same should be presented as other income. The company is of the view that the levy of income in the nature of delayed payment charges collected by it from errant customers is arising out of tariff regulations, and hence there is a direct nexus with the operating revenue producing activities of the company, and therefore delayed payment charges are not in the nature of interest. As far as disclosure of delayed payment charges in the statement of cash flow is concerned, it is contended by the auditor that to the extent surcharge represents time value of money, it should be presented as cash flows from investing activities. As per the company, the delayed payment charges are levied by DISCOMs owing to the SERC regulations, which are penal in nature and are arising out of normal business activities of the company. Further, the substance of delayed payment charges represents a compensation levied by the company, which is in the form of penalty. Hence, the said charges should be disclosed under cash flows from operating activities. The queryist has raised two questions here. First one is whether delayed payment charges being included by the company as other operating income under the head revenue from operations in the statement of profit and loss is correct, or whether delayed payment charges should be shown by the company as other income in the statement of cash flows, whether delayed payment charges being included by the company as cash flow from operating activities is correct, or whether delayed payment charges should be included as cash flows from investing activities or cash flows from financing activities. So these are the two questions that the queryist has raised on this particular issue. I request CA Vivek Nevatia ji to deliberate upon this particular issue, sir. Over to you, Vivek, sir.
Thank you, Guru Prasad ji. I think this appears to be a very, very small issue, because when we as consumers receive electricity invoices in our post box, I think it's a very normal terms and conditions which is put in the invoice, that if I do not pay the invoice by a particular date, I would have to pay a delayed payment charge. So I would have to pay a charge which would be in addition to the invoice amount which has been raised, and this is the amount of some kind of a penal charge or some kind of a compensation that I have to pay as a consumer to the electricity company, distribution company, for making a delay in the payment of my invoice. So the genesis of the query, or the issue that was raised by the C&AG on the accounts of the company, was that there was a particular expert advisory committee opinion in the past. So the basic, when we look at this particular issue, the one thing which EAC makes it very clear whenever it deals into every opinion is that the reference to earlier opinions is generally not warranted. It should serve as a guidance. It should not serve as a binding precedence, because each opinion is essentially based on the specific facts which were presented to the committee and may not actually apply to all the scenario situations. So we need to be very careful when we apply the expert advisory committee opinion in facts which appear to be similar but may not be similar, because the fact pattern could be quite different, and what the representation made before the committee could be quite different by another company vis-a-vis the earlier opinion. So coming to the opinion, when we look at this particular issue, I think, when we look at the nature of the delayed payment charge, fundamental issue that was pointed out by the committee was that you need to look at the nature of the payment which is being made. You cannot look at the legal form. You cannot look at the guiding circular or the law basis which this charge is being recovered. At a particular point, Mr. Guru Prasad referred to the electricity regulatory tariff basis which this delayed payment charge was levied. So what is the nature of the payment is the basis on which the accounting is to be done, not on the authority on which the delayed payment charge is being collected. So this is something which has to be understood, and therefore the nature of delayed payment charge has to be first understood to understand whether this delayed payment charge would form part of revenue from operations, or would it be classified as other income under interest income. So basis which we will decide on how the statement of cash flows will be presented. So when we look at delayed payment charge, so what we look at first Ind AS 115, which is revenue from contracts with customers. This delayed payment charge is a recovery made from the customer. So whether this would form part of the consideration receivable for the goods or services supplied by the entity to the customer is something which we look at from an Ind AS 115 perspective. So when we look at Ind AS 115, there's a definition of transaction price given. And what transaction price specifies is basically the price at which the entity supplies or sells its services, goods or services to the customer essentially. And this consideration which is there, this consideration receivable by the entity from the supply of goods or services is based on the nature, timing, and the amount of consideration which is receivable. The nature, timing, and amount could be, basis or could be determined basis whether it is a variable consideration, whether there's an existence of a significant financing component in the consideration, whether there is a non-cash consideration receivable along with the consideration, along with the subject consideration. And these are the parameters which you need to evaluate to determine the nature, timing, and the amount of consideration to be recognized by the entity on the sale of goods or services. Now, one contention which the entity put forth in the query was this penalty or this delayed payment charge was nothing but one form of variable consideration. Now, when we look at variable consideration from an Ind AS 115 perspective, when we looked at whether this would fall within the definition of variable consideration, the committee went on to look at how variable consideration was defined. So variable consideration was defined in a manner wherein I would be receiving a consideration which would depend on a contingency, which is an uncertain event in future, and for the purpose of transferring of promised goods or services. So if, for example, let's say there could be some certain contracts in which penalties are imposed. So if, let's say, I'm selling a particular goods, and if I have a condition which has been imposed on me that if I render this supply of goods within 30 days, I would be receiving 100 rupees. If I do not supply it within 30 days, I would be receiving only 95 rupees. So this contingency is dependent on a future event, which is there, which is a contingency which is there, and therefore the variable consideration clause kicks in. In this case, in the facts of the present case, however, this delayed payment charge is not a consideration for the supply of goods and services. If you look at the amount which is charged by the entity to each of the consumer is the same. Only when the customer makes a default in not making the payment within the due date, only then does the penalty kick in. And in the example which is given in Ind AS 115, the penalty is payable by the entity concerned, not by the consumer. So therefore, the difference with respect to variable consideration was brought out. And in fact, it was concluded by the committee that this cannot be a form of variable consideration, because what is happening here is, firstly, the penalty is paid by the consumer because he is not making the payment of the delayed payment of the electricity invoice on time. And this delayed payment charge is a compensation for making a delayed payment, not a consideration for the supply of the service concerned, not for the consideration for the supply of electricity concerned. And therefore, DPC or the delayed payment charge cannot be considered as variable consideration for the purpose of Ind AS 115. So once we are able to, say that it's not forming part of variable consideration, what is it? Is it therefore a financing component that is built into the price? Is it part of a financing component that should be accounted for separately? So what the committee did subsequently was, after determining that it is not part of variable consideration, it went on to evaluate whether a significant financing component was there in the price that is being charged to the customer concerned. So So basically, the how the Ind AS discusses significant financing component is basically that if I am selling customers at a cash price of X, and if I'm selling to another customer with an extended credit terms for an X plus a delta figure, in this case, this figure of delta is a significant financing component, and this should be accounted for separately if the figures are significant. So, for example, let's say if I'm selling goods to a customer for 750 rupees for a cash price of 750 rupees. If I'm selling to the other customer for a price of 1000 rupees with an elongated credit term of 3 years, this 250 rupees is generally considered as a financing component, which in this 115 goes on to say that this 250 should be accounted for separately as a financing component and not as a revenue from the sale of goods or service. So since there's a difference between the cash component and the non-cash and the cash component and the price that I'm charging because of the elongated credit terms, this 250 rupees is nothing but compensation for the time value of money and thus should not be accounted for as a revenue from sale of electricity. So how should I evaluate as an entity whether a significant component, financing component is present or not? So what is required to be evaluated is first, is there a difference between the amount of consideration, between the promised consideration and the cash selling price of the goods and services? So one argument could be that, this difference, this by payment of a delayed payment charge, there's a difference between the cash price today if I would have paid and the price that I would pay after 2 months because of the payment of delayed payment charge. So this difference could be argued as a significant financing component. The second is combined effect of two factors. One is the expected length of time between when the entity transfers the service and when the customer makes the payment. So the difference in delivering the goods or service and the receipt of payment and the rate of interest in the market. So if the rate of interest in the market is insignificant or maybe very, very low, so and the length of time is again very low, so in that case the Ind AS 115 specifies that there could not be a significant financing component, and there are factors which are required wherein you look at whether this significant financing component is present or not. In fact, Ind AS 115 actually gives a practical way out or a practical expedient to avoid complexities, wherein it stipulates that I need not adjust the amount for the significant financing component if the difference between the date of rendering or delivery of the service and the receipt of payment is less than 12 months. So if the period between when the entity transfers the relevant goods or service and the date on which I receive the payment is 12 months or less, I can adopt the practical expedient of not accounting for this financing component as an interest income and include that as the revenue from goods or services concerned only. So basically, when we looked at this issue, when the committee looked at this definition on how significant financing component was voted and how the practical expedient was given as part of the standard. And basically, when you look at the terms of the delayed payment charge, it was specified that this delayed payment charge would be levied at X percentage per annum. So there was a reference to the period for which the delay has happened. So when there was a reference to a period for which the delay in payment could be made by the consumer and basis which the interest or the delayed payment charge was calculated, the committee actually went on to conclude that this is nothing but a compensation for the time value of money. So I'm making a payment as a consumer to the electricity distribution company for the delayed payment charge if there is a delay in payment which is computed at a particular X percentage per annum. So this is nothing but a financing component. And if it is a financing component, I would have to evaluate whether this is a significant financing component. And this significance of the financing component has to be evaluated at a contract level and not at the overall global level. So you look at whether this particular financing component is significant from each contract perspective and not material from a financial statement perspective. That is something which is again brought out very well in the standard, because that is stipulated that this would unnecessarily add to the complexities of accounting for the financing component if I do it at a global level. So this financing component has to be assessed whether it is significant in nature. Assuming I adopt a practical expedient of not accounting for financing component, because the difference in rendering of the service or difference in the time when I'm supplying electricity or the raising of the invoice and the date on which I'm receiving the payment is less than 12 months, I can adopt the practical expedient of accounting for it as a sale of goods only, as a revenue from sale of goods, not as other operating income. Not as other operating income, because that would because that is what has been brought out in the opinion very, very nicely, that this amount which is received as a delayed payment charge, if I'm adopting the practical expedient of if the difference in the time frame is only within 12 months, then I would account for it as a revenue from the sale of the relevant goods or service only, and I would not be required to show it as interest income. If, on the other hand, if I'm not adopting the practical expedient, or the difference is significant in terms of the difference between the rendering of the supply of electricity and the receipt of payment is beyond 12 months, then the standard goes on to, then the committee's opinion goes on to say that this amount should be classified as interest income and should form part of other income. Because Schedule 3 of the Companies Act clearly stipulates that other interest income should be shown under the category other income, and other operating income would not be an appropriate reflection of the relevant income which is there. Because other operating income again has been defined in Schedule 3 as being a revenue which is generated from either from which is not from the sale of goods or services, but it is principal or but it is ancillary revenue generating activities, and therefore since this is not an ancillary revenue generating activities, and since I'm being compensated for the time value of money, this should form part as interest income and not as other operating income. And interest income is a specific line item which is reflected under other income under Schedule 3. So a better reflection would be shown as interest income under other income. So before going into the cash flow statement, I think I'll just take a pause here, and I will just have views of Navneet ji or Mr. Guru Prasad on this particular issue which has been discussed.
Yeah, I think, Vivek, this is very, very interesting and very relevant issues, not only for the power generation or supply company, but for other companies, even for the manufacturing and service industry also. And the important thing is the distinguishing point, the way you have explained that in this particular case, it is more of the time value of money or the financing component. So it all depends. Without concluding anything, let's say that there is a contract which says that your electricity bill is, let's say, 100 rupees. And it says that if you pay within first 10 days, you will get 3% discount, 10 to 20th day, 2% discount, and 21st to 30th days, you will get 3% of discount. Versus in this case, where it says that you can pay in next 15 days, after 15 days, the interest will be whatever, let's say 15% per annum. It may so happen that the commercially and the financially, the outcome is same, but the accounting outcome is very different. The way you explained the variable consideration versus time value of money. So I think one should be very careful in terms of a fact pattern and how the agreement is drafted, because Ind AS 115 is completely based on contracts with customers. So the contract and the drafting of contract is very important while concluding the accounting.
Thank you, Navneet. I think very, very relevant. Yes, Guru Prasad ji.
Yeah. Basically, instead of directly going into what is the interest component and then what is the finance activity, the committee has went on from the basics. Always it touches upon the definitions and then the basics. So they have gone on to say, basically, what is a transaction price? So what comprises of a transaction price? And then they analyzed the entire issue, whether this would fit into transaction price or not. Then they have gone to the next step of seeing whether it is a variable consideration. And then they have very detailedly explained what are the situations in which one can say that it would be a variable consideration, giving out examples. And then it went on even to say, if there is a financing aspect in it, then if there is a financing aspect, what are the various conditions that one need to see, various factors that one need to analyze. The committee has gone on to each and every item in that and then very elaborately explained. Because if you see the opinion, though the opinion seems to be very simple, but the way it has to be analyzed, if we see as a chartered accountant, practicing chartered accountant, when we have an issue, how we should analyze the issue, not basing on common sense aspect, but basing on the Ind AS and then the definitions and then step by step way of analyzing the issue and exactly see where this particular issue fits in. So that is the way the opinion is drafted, very wonderfully drafted. And you also brought out all these points, even the practical expedient clause also the EAC has very well explained over there. So this is very interesting opinion because this is something that we see day in and day out. People charge invoices and on the work order there is an interest if there is a delayed payment. So whether the delayed payment happens or not is a different thing, but how do we consider when it happens? It's a question that normally we don't really, check so much because it doesn't really become a material aspect. When we see couple of payments, small amount, we don't really pay so much of attention to that. But even the materiality aspect also needs to be checked here because it would be burdensome on the company if there is a financing activity to evaluate all that. So all this has been explained very well by you, that which is there in the opinion, well brought out. So please go ahead with the cash flow aspect. Yeah, thank you.
Thank you, Guru Prasad. I think, to understand the beauty of the opinion, we have to read the opinion.
Yes.
Something which is, has been, this particular opinion has gone into 19 pages. And if you look at the opinion, I personally, when I first, look at the word delayed payment charge, I think it's part of the invoice just credited to, other operating income. So it should be fine. In fact, other operating revenue is totally ruled out. Either it should be revenue from sale of goods or services, or it should be other income, depending on whether the financing component is significant or not. So that is something which has been very beautifully brought out in the opinion. And the way, you also explained the way it has dealt with Ind AS 115, I think it gives us a strong foundation or strong grip on reading Ind AS 115 and as to how to interpret Ind AS 115 as well.
Yeah.
And Vivek, just one thing on this practical expedient on the financing component. So one should be very, very careful while looking at Ind AS 115 versus financial instrument 109. This practical expedient for time value of money is there in Ind AS 115, whereas there is no such leeway under the financial instrument or Ind AS 109.
So does that cause a concern?
No, I'm just saying that to our audience, I'm just making that differentiation that yes, every standard it has its own nuances.
Agreed. I think very relevant. So coming to the committee, what it decided basis the discussions that we just had, that this particular amount delayed payment charge, if the entity concludes that this is not significant, or because of either the practical expedient or because for other reasons, if it assumes that if it concludes that it is not significant, it would form part of revenue from sale of goods or services only. If the practical expedient is not applied or the financing component is significant, in that case, this would fall under the category interest income under other income as per Schedule 3 of the Companies Act. Coming to presentation in the statement of cash flows, what the committee then did, it discussed the requirements of the Ind AS 7, which is statement of cash flows. So basically, we distinguished between the definition of operating activities and investing activities. So basically, operating activities are defined as the principal revenue producing activities of the company and other activities that are not investing or financing activities. Investing activities would mean essentially acquisition and disposal of long-term assets and other investments which are not included in cash and cash equivalents. So basically, the question which arose, whether a particular transaction can be split into two parts, because what is happening here is the consideration which is being receivable from the customer concerned is being split into two parts if there is a significant financing component, let us assume, into operating and investing. So is it permissible under the statement of cash flows to split a particular transaction under two activities, which is operating and investing? So the committee went on to say that there is there are provisions under the Ind AS 7 statement of cash flow which allows a particular transaction to be classified differently depending on the nature of transaction. One example that was given, or that is also there in the Ind AS 7 statement of cash flow, is if I'm making a payment or purchasing a property, plant, and equipment on deferred payment basis, which includes interest. The interest component is basically forming part of financing activities, and the payment which is being made by the particular entity concerned is forming part of investing activities as or acquisition of property, plant, and equipment. So there could be a scenario where a particular transaction, although one, is split into two parts. In the example which has been just discussed in the statement of cash flow standard, could be split up into investing and financing. So similar guidance was taken from that particular paragraph of the Ind AS 7, and what was stated that, of course, it is possible to differentiate to split the transaction into two parts. So the financing component or the interest income which is earned on account of delayed payment charge, assuming it is a significant financing component and classified as interest income, should form part of cash flow from investing activities, and the consideration which is receivable from the customer from the sale of goods or services or the sale of electricity would form part of cash flow from operating activities. So it is essentially permissible under the present cash flow standard to split the transaction into two parts depending on the nature. So basically, the committee opined that the cash flow statement should reconcile or should match with how the item is presented as part of the statement of profit and loss. So therefore, if I am presenting the item as part of revenue from operation, DPC, assuming if the practical expedient is applied or the financing component is not significant at the contract level, in which case it would form part of cash flow from operating activities. In case the financing component is separately disclosed as interest income under other income as part of Schedule 3, this should form part of cash flow from investing activities. One important point which was raised by the querist, and it appeared to be a reasonably good ground to argue, it was that since investing activities by definition means that acquisition and disposal of long-term assets. I have not acquired any asset here. This is not something which I've invested. So how can an interest income from that particular receivable be classified as a cash flow from investing activities? When you hear this argument, it appears to be a logical or a reasonable argument. But when you look at the opinion, opinion has looked into each and every aspect of arguments put forth by the querist. In fact, it says that this investment is not necessarily an investment which is being made out of its intent or will. Even investments which are circumstantial, which is in this scenario a circumstantial investment because of the delayed payment of the invoice by the customer, is nothing but a investment which is being made indirectly. It's a circumstantial investment which is there, and therefore the company's resources have been utilized to the extent for earning of interest income because of the circumstance in this year, in this particular facts. So therefore, the interest which is received in the nature of receivable would be therefore classified as a cash flow from investing activities, because the investment here was circumstantial in nature, and the argument of the company that just because I have not deployed any funds to make any investment would not hold good. Even a circumstantial investment would be covered within the purview of cash flow from investing activities. So this is how the committee concluded the opinion, and therefore what it concluded was the disclosure of the delayed payment charge would sync with the disclosure that is being made in the statement of profit and loss, either as revenue from operations or as other income under interest income, and therefore the same should be disclosed accordingly in the cash flow statement as well. So this is how the committee concluded with respect to both the issues, the questions which have been raised by Mr. Guru Prasad here. Over to Navneet or any comments or Mr. Guru Prasad, please.
Navneet ji, would you like to add something here?
No, I think Vivek has articulated all the facts and conclusion very nicely. Nothing further from.
Yeah. So as such, until now we haven't received any queries for deliberation. So we move on to the other opinions, and in case if there are any queries that come up later point in time for this particular opinion, we will discuss them later. Okay, so let me move on to the next issue that we have. Let me share the screen. The next query that we have is with respect to recognition of miscellaneous scrap items generated in the plant and scrapped assets awaiting disposal under Ind AS framework. The facts of the case: the company is engaged in mining of bauxite, manufacturing of alumina and aluminium, generation of power at captive power plant for use in smelter, and selling of alumina and aluminium both in domestic and international market. Besides, the company is also engaged in generation of wind power with setting up of wind power plants at distinct locations in the country. The scrap generated at the plant is of two types. Process scrap. Scraps generated in the process of aluminium metal production are known as process scrap and are reused in the process by remelting the same. The process scrap are not sold in the market. Miscellaneous scrap. Miscellaneous scrap are generated from various sources and constitute of scrap PPE, used spares, used transformer oil, electrical cables, steel scraps, empty containers carrying input material, used tires, etc. The sources of scrap and accounting treatment before it is considered as scrap is like this. Scrap property, plant and equipment. When an item of PPE is discarded after it completes its useful life or becomes uneconomical to be operated, the same is removed from the PPE and kept as inventory after scrapping. The company does not sell any item of fixed asset as such, as these discarded items of PPE are scrapped and sold as machine scrap. Accounting treatment before it is considered as scrap. Before an item of PPE is scrapped, the same is continued as fixed assets at its carrying value, which is WDV. Used spares. When a spare part of any plant and machinery is replaced with a new one after expiry of its useful life, the old used spare is collected for disposal and recognized as scrap. The treatment in accounts before it is scrapped is, with respect to major spares, as it forms part of PPE, accounting treatment explained at serial number 1 is also followed for major spares. For general spares, spares other than major spares are charged to repairs and maintenance expenses when it is issued from the store for consumption. So before scrapping, these spares are considered as revenue expenses. Used transformer oil. After a certain period of operation, old transformer oil is taken out and is replenished with fresh oil. The old used oil is kept as scrap. The accounting treatment before it is scrapped is like this. Fresh oil issued from transformer is charged to expenses before replenishment. Empty containers, bags containing input materials. Many chemicals used in the plants are supplied by vendors in containers or bags. The empty containers or bags are kept as scrap for disposal. The treatment in accounts, there is no identified price element of such containers which is otherwise included in the material or input cost. Hence, there is no specific accounting for such containers before it is considered as scrap item. Used tires. Many heavy earth-moving machineries, HEMMs, and equipments are engaged in mining and movement of materials. Damaged tires of such HEMMs are replaced with a new one, and the old one is kept as scrap. The accounting treatment that is accorded to in the company before they are identified as scrap is like this. The cost of the tires is charged to expenses when these are issued from the stores and fitted into HEMMs. So before considering them as scrap, the tires are charged to revenue expenses. Such kind of scraps are considered in this are collected in the scrap yard for disposal and are measured at every reporting date. The same is valued at available market price based on the last sale transaction or the estimated price fixed by the management for disposal. The change in inventory and sales of miscellaneous scrap are recognized as other income in the statement of profit and loss account. The inventory of miscellaneous scraps as on the reporting date is disclosed under the head inventory in the balance sheet with a distinct subhead as scrap. Whether the practice followed by the company to recognize miscellaneous scrap as inventory is correct, whether practice followed by the company with regard to valuation of scrap at its fair value is correct, whether the practice of the company to recognize the income out of sale or change in stock as other income is correct. These are the three queries that the queryist has raised, and I request CA Navneet Mehta sir to deliberate upon this issue and explain the EAC opinion on this particular issue for the benefit of the audience.
Sure, Guru Prasad ji. Yeah, thanks. So, Guru Prasad ji, basically, if you look at it, this query is on the scrap. But let me tell all my audience that this query is very, very important in terms of, because this is basically three-dimensional query where we have to fix the issue in terms of, first we will have to see the classification, then measurement, and then presentation. So in this case, the company is engaged in mining, refining, and selling of alumina and aluminium. And company is also engaged in generation of wind power. And in this process, the company has generated two types of scrap. Basically, the process scrap, that is the aluminium scrap, rejects and butts. And then there is a miscellaneous scrap, that is used spares, oil, lubricants, and packing material, containers, etc. So the query is mainly on this miscellaneous scrap. Okay, so the management view is on this miscellaneous scrap is that it is mainly generated from used spares, oil, lubricants, packing material, scrap plant and machinery, etc. So these items have no use other than selling as a scrap. So they are valuing it as the available market price based on the last sale transaction or the price estimated by the management. And the change in the inventory and the sale of miscellaneous income, they have been recognized as other income in the P&L. So this is how their practice they have been following so far. Now the question comes to EAC relating to presentation and measurement of this miscellaneous scrap. The querist has not raised the query on the process scrap. So we will only consider the issue relating to the miscellaneous scrap. So the committee, while EAC has opined on this matter, they have noted from the facts of the case that the major source of miscellaneous scrap is the scrap property, plant and equipment, used spares, transformer oil, empty containers and bags, and there are input material and used tires. So basically, if you look at it, there are two kinds of miscellaneous scrap. In case of the general spares or transformer oil, empty containers, etc., which are not treated as a PP, more of kind of consumables, and there are other scrap which were treated as a PP. So we will have to see the definition of the PP, definition of the inventory, and where this miscellaneous scrap will fit into it, and accordingly we will discuss their presentation and classification into the financials. So if you look at Ind AS 16, property, plant and equipments, it says that property, plant and equipments are the tangible assets that are held for use in the production or supply of goods or services, for rental to others, or for administrative purposes, and which are expected to be used more than one period. This is how the PPE are defined under Ind AS 16. It further says that the items such as spare parts, standby equipment, servicing equipments are recognized in accordance with Ind AS when they meet the definition of PPE. Otherwise, such items are classified as inventory. So these are the definition which I'm quoting from Ind AS 16. Now, if you look at the definition of inventory under Ind AS 2, it says that inventories are assets which are held for sale in ordinary course of business, or in process or production of such sale, and in the form of material or supplies to be consumed in the production process or in rendering of services. So these are the definition of inventory and PP from respective standards. So generally items such as spare parts, standby equipments or servicing equipments are inventory unless they meet the definition of PP. Now let's look at the miscellaneous scrap in the form of transformer oil and containers, bag, tires, etc., which are neither PP nor not inventory. So all this miscellaneous scrap item, as discussed, it cannot be considered as finished products or byproduct or intermediate product in process of production. So there is no question to classify it as an inventory, because at first place these are not assets, these are consumable which has already been written off in the books. So with regard to these scrapped items, the committee have note from the facts of the cases that these are already charged in the statement of P&L when these are issued or used and consumed, and therefore their entire cost has already been charged to the statement of P&L. Therefore, there is no question to write it back in the books, even if they exist physically, and accordingly, question of their presentation as inventory and valuation or revaluation at their fair value, etc. Those questions doesn't arise. Now, coming to the presentation of such scrap income, how to present those scrap income, we will take a clue from the guidance note on the Schedule 3. So basically, it gives an example that let's say there is a property, plant and equipment, which is when we discard or sell the property, plant and equipment, which is not the operating activity of the company. Hence, profit on sale of the property, plant and equipment should be classified as other income and not other operating revenue. And on the other hand, when the sale of manufacturing scrap, which is your core manufacturing or the operating activity, the scrap arising out of the manufacturing process or operating activity, that should be shown as in your other operating income under the revenue from operation. So we have seen that there are two kinds of miscellaneous scrap. The miscellaneous scrap, which is in the nature of PP, which is now has completed its useful life and discarded, should be, and the income arising out of scrapping those PP items should be shown as other income, whereas those consumable, etc., which is completely consumed in the operating process or manufacturing process, the income arising on those items should be shown as other operating income. And at the same time, for all those items which has completed their economic life, but economic benefit is still expected from scrapping those items. So one will also have to look at the requirement of Ind AS 105, that is the non-current asset held for sale and discontinued operation. If those items meet the definition of non-current asset held for sale, there are specific conditions given under Ind AS 105 that management is committed to sell those assets. There is an active plan has initiated, that transaction will be completed within 1 year, etc. If those conditions are met, then one will have to comply with the presentation and disclosure requirement of Ind AS 105. And again, the important point is in some of the industries, those scrap items have the very significant value, right? So in those cases, one will also have to look at the impairment requirement under Ind AS 36 for impairment of those scrap to test the impairment of those scrap items and to check their recoverable amount. So this is all about on this query from my side. Vivek, you may add something.
No, so Navneet, with your experience, just to ask a question here is, how have you looked at, when you look at financials, what is generally treated when with respect to scrap, which is forming part of PP? It is generally accounted for on disposal thereof, or is it forming part of non-current assets held for sale? How is the experience like?
Yeah, so in my experience, Vivek, generally these kind of scrap, because to form part of the asset held for sale under Ind AS 105, there are specific requirement. It is not the open choice. Right. So in most of the cases, I have seen those not forming part of the asset held for sale under Ind AS 105. Those are the normal PP under the asset register, under the fixed asset register. They maintain all those things, though their economic life or the value is the minimal or it is carrying at the zero value. But for the control purpose, they keep it in their fixed asset register. And as and when it is scrapped and sold, it is shown as other income.
Okay. I think the opinion has been very well discussed, Guru Prasad ji. Any other points from your side?
Yeah, a very well articulated opinion, and Mr. Navneet also explained it very well. Though the query is basically on miscellaneous scrap and then its accounting, the institute, committee has discussed at length on PPE also. PPE, if it is a scrap item, how is it should be? It should be reflected in books of accounts, and then what are the conditions basing upon which it would be removed from the books, and then even when you remove it, at what value it should be carried in the books, and also that while doing so, we also have to keep in mind the implications of impairment of assets under Ind AS 32, and also implications of Ind AS 105. So these aspects with respect to PPE also have been explained very well, which Navneet ji has also explained. Basically, if you see, this particular opinion is very common. This particular issue is very common for any manufacturing industry because they have PPE, they have major spares. When you have asked Navneet whether what do you see people doing with PPE which is scrapped, normally it is carried at in the, suppose if it is a major spare, and then the old spare is removed and then the new spare is kept in its place. The old spare will continue to be there in the books until it is disposed. But at the year end, normally we will have to do this impairment testing under Ind AS 32. Anyways, we have to do it. And if the conditions of 105, disposal of non-current asset, held for disposal of non-current asset, if it becomes applicable, we will have to apply that standard and then assess at the carrying amount or fair value less whatever is recoverable. So those conditions have to be checked, which the opinion also clearly says. So coming back to the question that you have asked Mr. Navneet about how do you see PPE, which is to be scrapped, unless the clauses of 105 get attracted, there is no way that we are going to value it at fair value. We will have to keep it in the PPE as normal PPE at carrying amount, which is costless depreciation. Mostly these PPE are totally useful life is over, only nominal value would be presented. So unless the conditions of 105 are met, we cannot take it to the 105 and value it at fair value. So here that part also has been very well explained by Navneet sir as well. It has been detailed in the opinion. So even with respect to at what point we will have to recognize it as other income and what point it has to be recognized as other operating revenue also, the guidance note is very clear on that. So where it says if it is a manufacturing scrap like transformer oil and all that, it needs to go into your other non-operating income. And then if it is PPE, it has to be into other income. So that also Navneet sir has explained it. So I think the issues that are raised in this query and then that has been answered by the committee, it has been well discussed. So I think we can go ahead unless any of you would like to add on this.
So just to clarify, Mr. Gupta, other operating income. I think by error you said other non-operating income. The process scrap should form part of other operating income, whereas sale of PP would be forming part of other income.
Yeah. Correct.
I think that is very right.
And impairment under Ind AS 36.
Yeah, impairment under Ind AS 36, not 32. Yeah, impairment under Ind AS 36 is very important because companies tend to keep them like that without checking the impairment.
Yes.
So every year when they do that review, they have to check only those are the only two occasions where we bring the value of asset to fair value. Yeah.
Agreed.
So let's move on to the next query in that case.
Sure.
The issue is basically accounting treatment of revenue on conversion of leasehold land to freehold land under Ind AS framework. Facts of the case: company during financial year 2019-20 sold a land at A place to K Corporation of State Government at the rate of rupee 1 crore per acre in lieu of freehold right over other land situated in E village, presently held by company as leasehold land. The company received the monetary consideration during financial year 2019-20. Further, the Industries Department, State Government issued order in 2019 granting freehold right over land in E village. According to the queryist, the order issued by Industries Department was not sufficient enough for materializing the transfer of property into freehold, since Revenue Department is the competent authority for land-related matters. The company recognized the monetary consideration as revenue. In the financial year 2019-20, the value of the land proposed to be converted as freehold was neither recognized as income nor asset, since a valid order from Revenue Department was not received, nor the title deed was transferred to the company. The value of the said land in the books of account as on 31st March 2022 was nil. During the financial year 2022-23, company received the order from Revenue Department ratifying the order of Industries Department and conveying government sanction for unconditional assignment of the land to the company. Accordingly, in financial year 22-23, management decided to recognize the value of the land in the books of account and the corresponding revenue. The land is proposed to be accounted for at its fair value, as the exchange transaction does not lack commercial substance, and fair value of assets sold and the land for which the title deed was received can be measured reliably. As per Ind AS 16, the amount of consideration to be included in the gain or loss arising from derecognition of an item of PPE is determined as per Ind AS 115. As per Ind AS 115, entity shall include in the transaction price some or all variable consideration only to the extent it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty associated with the variable consideration is subsequently resolved. As per the queryist, considering the requirements of Ind AS 115, transfer of non-monetary consideration in the contract was contingent to the issuance of the order of the Revenue Department sanctioning assignment of land in favor of the company. In the financial year 2019-20 and subsequent reporting periods, as per the assessment made by the management of the company, it was not highly probable that the order will be issued by Revenue Department. The query that we have is whether the management's proposal to recognize the fair value of the land on the date of order of Revenue Department and equivalent amount as property, plant and equipment is in order considering the relevant Indian accounting standards. Whether the management's proposal to recognize the revenue and PPE during the financial year 22-23 being the year in which company has received valid order from Government of Kerala is in order considering the relevant Ind AS. I request CA Vivek Nevatia sir to deliberate upon this particular issue. Over to you, sir.
Thank you, Guru Prasad ji. Again, this is a very interesting issue to be discussed. And this deals with, again, variable consideration we discussed in the second query. This also discussed with how an exchange, asset PP received in exchange is accounted for. An exchange of a consideration received in kind or non-monetary consideration is accounted for. So these issues have been very, very fairly brought out in the opinion. And also how whether the rights would be received or whether do I have the rights in the year 1920 or 22-23 when the registration of the particular land happened is again what has been discussed in the opinion concern. So basically, if you look at the query or the facts of the case, basically there were two land parcels which the company had. So what happened was one land parcel was sold to the government at a particular price per acre. And there was another parcel of land which was sold at a particular value of rupees 1 per acre, rupees 1 crore per acre. And in lieu of which I received, so there was another land parcel in lieu of which I received monetary consideration of 1 crore per acre and also freehold rights over some reduced parcel of land. So basically, with respect to one area, I received only monetary consideration. With respect to the second parcel, I received monetary as well as non-monetary consideration. So when we are talking about this particular opinion, we are restricting ourselves to the issue with respect to the second land parcel. Issue with respect to the first land parcel was not raised by the querist and has not been discussed by the committee in its opinion. So we are only discussing the issue with respect to the second land parcel wherein we receive monetary as well as non-monetary consideration. Now, when we look at this particular query, we had assumed certain facts which were put forth by the querist. So the committee, in its initial para or the disclaimer paragraph which is there, it has assumed that the exchange transaction in the instant case, whether the exchange transaction lacks commercial substance. So basically it has assumed, as per the queries, that the exchange transaction has commercial substance, and therefore it has basically proceeded accordingly. So it has assumed, based on the version of the queries, that this exchange transaction has commercial substance, and therefore accordingly the opinion has been evaluated by the committee. So second is whether the fair value of the assets sold or given up and the fair value acquired can be measured reliably or not. It has assumed again that the fair value can be measured reliably based on the contention of the querist here. So these are the two factors which has been considered by the committee before going into the opinion. So coming to the exchange transaction, let us look at the requirements of Ind AS 16 property, plant and equipment. What does Ind AS 16 stipulate in respect of an exchange transaction? So Ind AS 16 PP recognizes the fact that there can be items of property, plant and equipment which are acquired in exchange for another non-monetary asset, or it could be a combination of monetary and non-monetary assets. So what happens if I have an exchange of an asset, non-monetary asset, with another? So in that case, Ind AS stipulates that the cost of the item is measured at fair value. So the cost of the asset acquired is measured at fair value unless the exchange transaction lacks commercial substance or the fair value of neither the asset given up nor the asset received are reliably measured. So in this case, we have assumed that the exchange transaction is not lacking commercial substance, and therefore the cost has to be required to be measured at fair value. Second, the fair value of the assets can be measured reliably, and therefore the cost has to be again measured at fair value, the cost of the asset acquired. So since we have assumed as the exchange transaction has a commercial substance, I'm not getting into the requirements of when an exchange transaction lacks or does not lack commercial substance. So the fair value of the measured asset generally is considered as can be considered as reliably measured if the variability in the measurement of the cash flows of that asset, or the fair value measurement of that asset, is not significant, and the probabilities of the estimates are within a particular range. So therefore, if I'm able to measure the fair value of the land which is given up or the fair value of the land which is acquired reliably, I actually do not fall within the exception clause for the exchange of PP, and in which case I would have to recognize the asset which has been acquired at fair value. Now the question arises, at what price should the fair value be recognized? Should it be the fair value of the asset given up, or should it be the fair value of the asset acquired? So what Ind AS states is the asset which is given up should form the basis of the measurement for the freehold land acquired, unless the fair value of the freehold land is clearly more evident. So the fair value of the asset given up is considered as a more reliable measure. If I'm unable to reliably measure the cost of fair value of the asset given up, in which case I will take the fair value of the freehold land which is acquired, which is more evident, if it is more evident. So coming to the requirements of Ind AS 16, when we have discussed since we have assumed that the exchange transaction does not lack commercial substance and the fair value of the asset given up or the asset acquired can be measured reliably, so we are now required to understand the point of recognition, at which point would the property, plant and equipment would be recognized. Whether it would be the financial year 1920 when the order is issued, or the year 22-23 when the revenue department has given a formal order and the registration has happened. So when we look at the definition of the property, of the timing of recognition of the cost of property, plant and equipment, what it stipulates that the cost shall be recognized if and only if it is probable that future benefits, economic benefits associated with the item will flow to the entity, and the cost can be measured reliably. So we have already answered the cost reliably, whether it's measured reliably, favorably. So when is the time when it is probable that the economic benefits associated with the item will flow to the entity? What is specified in the standard is that there should be a high degree of certainty attached to the flow of future economic benefits. There should be a high degree of certainty, and when there has been a communication and order by the department, by the industries, and there was no disagreement or dispute with respect to the economic benefits which are available to the company with respect to that freehold land, and the registration would be merely a legal formality. It's just a compliance of the order or the directions which have been issued basis which the registration has happened in 22-23. The title deed or the transfer of title, the transfer of the registration is not considered as a substantive event. In fact, when I have constructively acquired the asset today in the year 1920, when basis the order, I'm entitled to the economic benefits attached to the freehold land that is available to me, because it is merely an exchange transaction which is there. The transaction should have been recognized at the inception itself, which is the financial year 1920. However, committee has gone on to say that we need to give appropriate disclosures with respect to the legal title of land, that the registration is yet to be completed in the financial statements. But the fact that I have taken control of the asset, there is a flow of future economic benefits which is available with a high degree of certainty to the company based on the order of the ministry. The company is also a PSU. The Department of Industries has already given an order to that effect. Only the formalities with respect to the registration or the legal correction or legal rectification of the title needs to take place. There's no dispute with who the control of the asset is. The economic benefits would be transferred in the year 1920 at the inception and not in the year 22-23. So therefore, the asset should be recognized or the basis fair value in the year 1920 and not in the year 22-23. Coming to the asset which has been acquired, we have discussed the relevant clauses of the accounting of the relevant Ind AS. Coming to the asset which has been given up, when the committee discusses a particular issue, it just does not stop at arriving at an opinion on the timing and the cost of the asset which is acquired at fair value. It actually goes on to discuss the de-recognition requirements of the asset which has been given up. So a very important point which has been discussed is we look at how the de-recognition principles are laid down in Ind AS 16 of property, plant and equipment. So when we look at the de-recognition principles, so I will recognize, of course, when no future economic benefits are expected from its disposal or on disposal, and how the consideration is supposed to be recognized on de-recognition of a particular asset concern. So what it specifies is the amount of consideration to be included in the gain or loss which is arising on disposal or de-recognition of a particular property is determined in accordance with the requirements of determining the transaction price in accordance with Ind AS 115. So Ind AS 16 takes us to Ind AS 115 to determine the transaction price which is receivable on de-recognition of a particular asset concern. So I'm not going to discuss again the principles of transaction price because we have already discussed the principles of transaction price when we looked at the second query. And basically, if we discuss in respect of the transaction price, what para 66 stipulates of Ind AS 115 in respect of non-cash consideration, it specifies that to determine the transaction price for contracts in which a customer promises a consideration in form other than cash, an entity shall measure the non-cash consideration at fair value. So what Ind AS 115 para 66 again stipulates that the consideration, the non-cash consideration should be measured at fair value. So the transaction price is the amount of consideration, including non-cash consideration, which an entity would be entitled to in exchange for the land parcel which I'm handing over to the government of Kerala. So the land which has been given up and the value or the non-monetary asset which has been acquired, the fair value of the non-monetary asset again has to be considered here for determining the consideration which is receivable for the purpose of accounting here. The querist had raised a particular issue with respect to the uncertainty at the time of exchange transaction because the registration has not yet happened. The freehold rights were not absolute in nature. So what the committee stipulated, that what the committee opined, that this unconditionality was not part of this is not something which can be referred to as a variable consideration. This is something which is already absolute as part of the exchange transaction, is already there in place. The economic benefits of the asset acquired is already there. We have lost based on the order. There's an exchange of economic benefits which has already occurred, based on which this profit or loss on sale of property, plant and equipment, or the derecognition of property, plant and equipment should be classified as other income and not as revenue as put forth by the querist. So the promised non-monetary consideration is the exchange transaction cannot be considered as a variable consideration in accordance with Ind AS 115, as was being contended by the querist, because the consideration was promised. There's no question on variability of the consideration. The consideration was already identified. The land was already identified in place, which the company was already using for the purpose of its economic use. So therefore, when you look at the exchange transaction, the fair value of the asset which has been given up would be treated as the value, as the consideration, unless the fair value of the asset acquired is more evident or more reliably measured. With respect to derecognition, again, one more important point which has been put forth by the opinion is that we need to look at the ROU asset derecognition, because the asset which was there was the right of use asset, the leased asset. So again, this point was very beautifully brought out, and we should ensure that the derecognition requirements of Ind AS 116 leases is taken care of when the derecognition principles of a leased asset, of a right of use asset, is considered. So these were the nuances which were put forth by the opinion, and I think this was very well brought out in terms of how an exchange transaction would be accounted for, in terms of when the point of recognition would be. When the registration of a particular land has not happened, but the control of the land is still with us. So how would that be accounted for? What would be the point of recognition? How would the derecognition criteria would be looked at, and how would it be met? And how you look at Ind AS 115 to determine non-cash consideration? How a particular REU asset which being given up would be derecognized in accordance with the principles of Ind AS 116. So there were multiple principles which were discussed before the committee, and a very informed opinion was taken to arrive at the opinion. I think this is how I would look at the opinion, and the committee looked at opinion. Any other points which are relevant and can be brought out, Navneet or Mr. Guru Prasad? I think we can just, Navneet, if you can just discuss on maybe, exchange transaction lacking or not lacking commercial substance, that would be just relevant if it's possible.
Yeah, Vivek. So basically, I think the key takeaway from this query is that the interaction between Ind AS 115 and Ind AS 16, the revenue standard versus PPE standard. So basically, the way you have explained that your transaction price and derecognition of the PPE will be determined by the Ind AS 115. And while coming to the commercial substance, whether the particular transaction has commercial substance or not, that's very subjective and very qualitative discussion, and it depends on facts to facts. But the only thing I can tell you, that one can see there are some indicators which are given in the standard, that you look at the cash flow pre-transaction and post-transaction, and if there is a material difference or not, that may be the indicator of the whether the transaction has the commercial substance or not. But again, as I said, it's very qualitative and depends on fact to fact, so we can't generalize this discussion. But of course, it's very important while looking at the transaction and recognizing, derecognizing, and for all those points, it is very important.
Yes, sir. Now, Vivek, you would like to quickly conclude the opinion because you haven't concluded the opinion in which year it has to be taken.
No, so I actually stated that the exchange transaction had to be accounted for in the year 1920 only, the year in which the order of the Industries Department of Industries was there, based on which the exchange transaction was there. The legal registration in the year 22-23 is mere perfection of the title. The control was already with the company in the year 1920 itself, and therefore the exchange transaction should have been accounted for in the year 1920. So committee in its very in its wisdom also therefore has said specifically that we are scoping out in AS 8 with respect to accounting policies, changes in accounting estimates and errors, because that would be another chapter altogether. If we are supposed to rectify, if at all there was an error in the financial statements, if the company accounts for it in the 22-23. So when you look at an opinion which is being formed by the committee, we need to be very careful about the scope, para, and the points which are considered by the committee, with the points which have been scoped out and has been not dealt with by the committee concerned when forming an opinion. Because when you look at a committee's opinion, it's always limited to the specific queries, and it is based on the assumptions which the querist has put forth. That is why it's not a straitjacket formula wherein you can apply this query across. You have to be mindful of the facts. You have to be mindful of the particular situation of the querist, which is a PSU company, how the control was there on the land concern. These are facts which are subjective and have to be evaluated on a case-to-case basis and cannot be applied universally. So we need to look at, again, each fact pattern separately. Whether the reliability measurement clause is getting applicable in respect of the fair value of assets. How would fair value be measured in accordance with Ind AS 113 fair value measurement? These factors have to be separately considered when you look at a particular issue in hand. We need to be mindful of the principles which have been brought out by the opinion and not just be swayed by that this can be applied across all cases, similar cases. So I think this is something which is an important takeaway.
Yeah. Yes. Particularly in this particular case, particularly if you see the property, plant and equipment, its recognition, basically timing of recognition, the probable future economic benefits associated with the asset should flow to the entity. And in this particular case, it is very clear because even before acquiring that asset, it is under their leasehold control. So as such, they have been taking economic benefits from that particular asset, and then the control remained with them. And it is only a conversion from freehold to leasehold to freehold. So there, it is the facts are very much in favor of recognizing in 2019-20 because the probability of future economic benefits flowing to the organization can be easily established there. So it is very well discussed opinion, as you have elaborated on all aspects. So finally, as you said, every opinion we will have to see as to what the committee is scoping out certain aspects and what is it scoping in. And it also depends upon what the queryist is asking also. Sometimes queryist is not asking certain questions, so the committee also does not answer them. But we will have to only stick to the facts, as you rightly said, and then see what is being scoped out and then understand to correlate these opinions to other the situations that we have on our day-to-day audits. It is very important because we have to see if the facts are matching or not, and the principles behind which the opinion is given. If that principles, if we can pick them correctly, we'll be able to apply it in our regular issues also very easily. Very rightly said. So, Vivekji, if you would like to add something, otherwise we will move on to the next issue.
Just one point, Guru Prasadji. I think the fact that the querist has assumed that the exchange transaction has a commercial substance is a very, very important point here. Yeah. And that has actually been assumed by the opinion at the time of has been assumed by the committee at the time of forming the opinion. This point actually is very significant, and as Navneet ji rightly pointed out, it's very subjective based on how the test of commercial substance is required to be evaluated. So this is again very, very relevant.
Yeah.
And Vivek, just on this commercial substance, in this case, it seems a commercial substance because against the land which you are selling, you are getting monetary consideration, of course. And the non-monetary thing is that you already possess that land as a leasehold land, and now you are going to get as a freehold land. And I'm assuming there is a significant gap between the remaining lease period versus the freehold land. So just to answer your question, that what could be the example, may or may not be, depends on the commercial substance. Let's say I have the leasehold land, which is the perpetual lease kind of thing, or there is a continuous renewal without paying significant premium, and against that I'm getting the freehold land. So I think in that sense there is no commercial substance, because the land I have as in the name of the leasehold, it is as good as a freehold land, and the land which I'm going to get is anyway freehold land. So there is no commercial substance. You are not going to get any additional penny out of it. Right?
Agreed.
Yeah.
Agreed. And very relevant. I think Navneet, I think very beautifully brought out that yes, this could be argued as a transaction which has a commercial substance based on the fact that I'm receiving a monetary consideration. Again, we need to look at significant again materiality perspective, also from a financial statement perspective, as to the amount which has been received or the pre and post cash flows as identified. Those are factors which need to be evaluated. So again, as you said, this
detailed evaluation is always required, because devil is always in details.
Yes. Okay, so if you both agree, we will move on to the next issue. Yeah. The next issue that we have is classification and presentation of amount paid for acquisition of land as inventory or as advance under Ind AS framework. A company operates, facts of the case are like this: a company operates into 3 business segments: project management consultancy, real estate and engineering, procurement and construction. City Development Authority, CDA, has allotted a group housing plot to the company in the year 2015. The company has paid full consideration to CDA as per allotment letter and recognized the same as land inventory in the year 2015. While conveyance deed or lease deed in respect of the said plots are yet to be executed, the possession of plot could not be obtained due to raising of additional demand for infrastructure charges by CDA, which the company did not accept. The company wrote to CDA for cancellation of the plot and requested to refund full consideration amount with interest to the company. CDA has given 2 options: either to execute the conveyance deed after paying infrastructure surcharge, or withdrawal of allotment after deducting 10% of land consideration amount. Thereafter, a letter was sent to Principal Secretary, Housing and Urban Planning of the state from the company, wherein it was requested to give necessary instructions to CDA for execution of sale deed on the same rate as informed by allotment letter, or to refund the complete consideration amount with interest. The queries has raised one question: whether the company may continue to present the consideration paid to CDA for land acquisition as land inventory, or transfer the same to advance. I request CA Navneet Mehta sir to deliberate upon this particular issue. Over to you, sir.
Sure, Guru Prasad ji. So if you look at it in this fact, basically the local authority, that is the Ghaziabad Development Authority, they have allotted a plot to the company long back, somewhere in 2015, and company has paid full consideration, and that conveyance deed or lease deed in respect of the said plot is yet to be executed. And subsequently, that the GDA, that local authority, has come up with asking for the additional charges, that infrastructure charges, and the company has refused to pay it. So they have requested, there is a lot of to and fro between the local authority and the company. And finally, the company has written to the Principal Secretary to award this land in the favor of the company. And company has not got the access to the land or not able to get the control of the that particular land. So this is the broad fact. And then the queries has recognized that land as their land inventory. And then the question was raised whether it is the land inventory or it is the advance for the land or something else. So this is the basic query which was raised. So basically, if you look at it in this case, it is clear that the company has not cancelled or terminated the allotment or surrendered the land, and therefore the settlement of the contract for the allotment of land is in terms of land only and not in terms of cash or another financial assets. So basically, the company has not asked for the refund or the cancellation. Their primary ask was to settle it through the land. So let's examine that whether there is any asset exists, and if yes, whether it is the land itself or it is the advance for the land. That is the mute question which we have to assess. So for that, I think we have to assess the definition of the asset. What is the asset under the Ind AS framework? So basically, Ind AS framework says that an asset is a present economic resource controlled by the entity as a result of past events. And what is the economic resource? Economic resource is that the potential to produce economic benefits. So out of these definitions, we can see there has to be at least 3 elements in a particular thing to call it as an asset. That is, there has to be right, there has to be a potential to produce economic benefit, and you should have control over it. So while looking at the right, what is the right? Because right can be like right to receive cash, right to receive goods or services, and then potential to produce economic benefit. Now, when I'm saying potential to produce economic benefit, and to exist the potential, it does not need to certain or even likely that the right will produce economic benefit. It is only that the right already exists, and that in at least one circumstances, it would produce for the entity economic benefits beyond those available to other parties. So it's not necessary that there has to be economic benefit, there has to be potential to produce economic benefits. Now coming to the control element. So control element basically includes the present ability to prevent other parties from directing the use of the economic resource and from obtaining the economic benefit that may flow from your control. So it follows that if one party controls an economic resource, no other party controls the resources. So while looking at the definition and the primary element of the asset, we can say that asset can only be recognized when there is a right, when there is potential to produce economic benefit, and there is control over the resource. So in the given case, the possession of the plot has not been obtained by the company, and the sale deed is yet to be executed, right? So the company does not have right over the land. Just see my words. I'm saying company does not have right over the land. I'm not talking about the money which company has given to the local authority. I'm just talking about the land as of now. So looking at the definition and element, we can say that company does not have right over the land, and therefore there is no potential of the economic benefit from the land as an asset in the extent case. So as far as control is concerned, company does not have ability to direct the use of land or to prevent other parties from directing the use of or benefiting from the land in the absence of possession of the land. So in this case, the land should not be recognized as an asset. It's very clear. Hence, the question of classifying the same as inventory, which the querist has raised, that doesn't arise. Now, the next question before us is that whether the advance paid to this Ghaziabad Development Authority gives the company to right to receive the land on completion of necessary formalities, and therefore that advance has potential to produce economic benefit, right? So therefore this advance paid for the land meets the definition of the asset, and the company should recognize that as an asset in its financial statement rather than the land. So we are able to conclude that the advance given for land should be recognized as an asset and not the land itself. Now, the other incidental question is, when I'm saying that advance for the land is my asset, whether it's a financial asset or non-financial asset, right? So let's look at the definition of the financial asset. So financial asset is the asset which is the cash or any equity instrument of other entity, or the contractual right to receive cash or another financial asset of another entity on the potentially favorable terms to the entity. So basically the contractual right to receive cash or another financial asset on potentially favorable terms, that gives rise to the financial asset. But in this case, if you look at it, the company has given the advance to the local authority and company has right to receive the land, which is not the financial asset. Further, any asset such as prepaid expense, right, for which the future economic benefit is the receipt of goods or services rather than right to receive cash or another financial asset. So your prepaid expenses are not financial asset. So essentially, asset for which future economic benefit is the receipt of goods rather than right to receive cash or another financial asset are not financial asset. So in this case, the advance paid for the land gives you right to receive the land is not a financial asset, it's a non-financial asset. And further, one should keep it in mind the disclosure requirement of Schedule 3 relating to the capital advances or advances, and should be disclosed accordingly in the financial statement to give the true and fair picture of the transaction. So that's it from my side. Vivek, Guru Prasad ji, you want to add something?
Oh, I think this opinion is a good offshoot to the opinion, the last query which we had, wherein the control was there from the year 1920 or day one when the exchange transaction happened. And in this case, the advance was paid, but the control over the land was not there, so that the economic benefits from the land could be available. The economic benefits in the form of advance is there, which is an asset, right to receive the allotment of the land or right to receive possession of the land. But the land per se as an asset was not there in this case, vis-a-vis the earlier opinion wherein the land was within our control and therefore the possession was there with us on day one. So this has to be very clearly understood as to when the control over the particular asset is there or the economic benefits associated with the particular asset arises. So this has to be looked at very, very carefully from an asset definition, from a property, plant and equipment definition. So this has to be looked at very, very nicely, carefully when you look at property, plant, when you look at the definition of an asset and when the control over a particular asset comes into existence. I think this is relevant. I think this was all from my side. Any further additions which you have?
So Vivek, the query which you discussed and the recent query, this is a very good example of the substance over form, right? And accounting is always based on substance over form.
Agreed. I think very, very relevant, I think. Guru Prasad ji, your comments, sir.
Yeah, compared to the previous one, it is just a contrast where the position is there and then here there's no position. For sure, there is an asset, but what asset it is something which needed a lot of discussion. The committee elaborated as to what an asset is and then right, control, and then to which asset actually the company has right and control. It is very nicely brought out. And even whether the asset is a non-financial asset or a financial asset also, it has been elaborately discussed. And then even Navneet ji has also elaborated. It is nicely brought out. There is an asset for sure, but what asset is it? Is it land or is it an advance? So that was the question. And then finally, the answer is very elaborately given in the opinion. And very nice that both of you have brought out the key aspects of that particular opinion for the benefit of the audience. So as the time is closing in, we will just leave out the last opinion. Probably we will take it up in the next webinars. Is there anything that you would like to finally add on the opinions that we have discussed today? Otherwise, I will move on to the vote of thanks, formal vote of thanks section.
Yeah, Guru Prasad ji, I would like to thank you for moderating this session in very well manner, and thanks to Vivek. Thank you so much.
Same here, Navneet. I think it was wonderful. I think the opinions, also the structure of the opinions, I think was very well done in terms of, taking the first two queries on cash flow statement and discussing on operating income and other income. And then moving on to accounting for scrap sale and coming to the fourth opinion on the timing of capitalization of land, which is already under our control, vis-a-vis taking over acquiring of land which is yet to be done, or the possession of land which is yet to be done. I think the 5 opinions which we have discussed are relevant and are coming together as a good bundle of discussions which could have taken place. I think. Thank you for moderating it so well. Thank you
Very much for your good words for me. And I hand over the webinar to the Vice Chairman of EAC, CA Piyush Chacharji, for his formal vote of thanks. Thank you.
Good evening, everyone. Vice Chairman sir could not join due to his some prior commitments, and it was a wonderful deliberation. I am CA Khushbu Bansal from Expert Advisory Committee, and on behalf of our committee, we would like to thank all the people for joining today's webinar. We appreciate your time and engagement. We want to extend our gratitude to the speakers for the webinar, CA Navneet Mehta, CA Vivek Nevatia, and CA Guru Prasad ji for steering today's webinar. The views expressed in the panel discussion were insightful and gave guidance on many relevant issues. We believe that the deliberations at the panel discussion will be of immense help to the participants. We are sure to give the benefit of EAC expertise and in future as well. Thank you so much, everyone. Thank you.
Thank you.
Thank you.